Hi everyone, and welcome to this explainer. Today, we're unpacking a fascinating and honestly pretty critical issue that's hiding right in plain sight. We're looking at the complex intersection of mortgage finance data and discriminatory lending. Specifically, we're going to break down how aggregating massive amounts of data can accidentally or intentionally lead to biased lending, resulting in a whole mess of regulatory fines, reputational damage, and mispriced loans. We'll be looking at the exact frameworks the financial industry uses to uncover these hidden biases.
So, have you ever stopped to wonder how exactly lenders determine your specific loan terms? Think about it. When you apply for a mortgage, a truly staggering amount of information gets processed completely behind the scenes. We usually just accept the interest rates and fees we're handed, but this opaque, data-heavy black box is doing a ton of heavy lifting. It's evaluating creditworthiness, collateral, risk, the whole shebang. But because it relies so heavily on complex models, it opens the door to a very specific and highly dangerous set of risks.
And right here is the central conflict. Complex data aggregation decides your rates, your fees, your terms. But what happens when the math gets it wrong? Or worse, what happens when the very models designed to be completely objective inadvertently bake discrimination right into the origination process? Look, this isn't just a hypothetical problem. It's a massive operational and financial risk for the institutions actually originating these loans.
So, here's our roadmap for the explainer today. We'll start with 1, the data aggregation dilemma. Then 2, the cost of bias. 3, tracking minority lending metrics. 4, measuring monetary losses. And finally, 5, policies to ensure fairness. Let's get into it.
Section 1, the data aggregation dilemma. How lenders decide terms.
The mortgage industry provides a seriously essential public good, which is home ownership at scale. But to achieve that massive scale, lenders absolutely have to rely on aggregating data. This data dictates everything. It decides the exact loan size you qualify for, your specific interest rates, your upfront discount points, and all those other fees. Every single one of these variables is basically spat out by a giant data funnel.
Which brings us to a crucial point. This highly complex process can absolutely result in discriminatory lending practices. Now, what's really important to take away from the source material here is that this bias can be intentional or completely unintentional. Actually, even if a lender has zero intention of discriminating, their algorithms might unintentionally price certain loans differently for different demographics. The bias can literally hide perfectly within the math. Moving on to Section 2, the cost of bias. From bias to loss.
When bias sneaks into the data, it creates a massive business risk, triggering what is basically a devastating domino effect. It starts right at step 1, data aggregation bias. Once that bias infects a loan portfolio, it almost inevitably leads to step 2, huge fines and regulatory penalties for violating lending laws. Then, this immediately triggers step 3, intense reputational risk, which severely damages public trust in the institution. And it all culminates in step 4, negative financial performance. Because think about it, if you're systematically mispricing loans because of biased algorithms, your bottom line is absolutely going to suffer. It's a compounding disaster.
All right, Section 3, tracking minority lending metrics. Tracking the data. To track all this, investors rely on a really powerful framework, the SASB standards, which are now part of the IFRS Foundation, provide exact sustainability accounting metrics to assess these specific risks. And for the mortgage finance industry, there's an entire set of metrics dedicated strictly to exposing discriminatory lending. But obviously, to measure this accurately, you need ironclad definitions. So SASB cleverly bypasses local definitions by using the United Nations definition for a minority borrower. The UN defines this as a group constituting less than half the population whose members share common characteristics of culture, religion, or language. This is great because it ensures that when entities report their data, they're using incredibly clear, objective, globally recognized terms. Now, one of the most powerful tools in this standard is metric FN MF 270.1. This basically forces mortgage finance entities to put minority borrowers and all other borrowers side by side. They have to explicitly report and compare the total number of mortgages, the total financial value, and crucially, the weighted average loan-to-value ratio. By forcing this direct side-by-side comparison, investors can immediately spot any glaring disparities in how capital is being allocated. Actually, let's zoom in on that last metric for a second, the weighted average loan-to-value ratio. Why is this specific calculation so important? Well, it's because it helps reveal potential hidden disparities in loan terms.
The standard requires entities to calculate this by weighting each loan-to-value ratio by its respective loan amount. This normalizes the data. It prevents a few massive, multi-million-dollar commercial loans from completely skewing the data of thousands of smaller residential loans. It gives investors a highly accurate, normalized way to spot mispricing across massive, complex portfolios.
Okay, Section 4, measuring monetary losses, or the actual financial damage. This part is covered by Metric FN MF270B2, which tracks the real-world financial damage. Entities must disclose total monetary losses from actual or even alleged discrimination lawsuits. We're talking civil judgments, regulatory penalties, restitution, and criminal fines. But here is a brilliantly strict detail. The standard specifically excludes the entity's own legal defense fees. You absolutely cannot pad your damage numbers with your own expensive corporate lawyers. Investors only want to see the actual punitive and restorative cost of the bias itself. Which brings us to our final section, Section 5, Policies to Ensure Fairness. What are the internal safeguards? Well, to safeguard against bias, you kind of have to know exactly what you're fighting, right? The standard clearly outlines that internal policies must actively prevent discrimination based on race or color, religion or national origin, sex or marital status, age, or whether any of the applicant's income derives from public assistance programs. Entities have to explicitly explain how they ensure comparable loan terms regardless of these specific factors. And Metric 270B3 demands entities explain exactly what these safeguards are. They generally fall into two camps. On one side, you have internal controls. This is all about human oversight, rigorous training for your underwriters, and incredibly strict record keeping. On the other side, you have portfolio monitoring. This is a purely data-driven approach that proactively tracks the entire portfolio for race, gender, and ethnicity to catch that unintentional algorithmic drift we talked about. Essentially, it takes well-trained humans to check the math and rigorous data monitoring to check the humans. So, we've seen how the incredibly complex process of mortgage data aggregation can unintentionally hide bias, and how strict frameworks like the SASB standards give investors the tools to finally expose and mitigate that risk. But I want to leave you with a broader thought to chew on today. If standardizing data and demanding pure transparency can expose the true cost of hidden bias in something as heavily regulated as mortgage finance, what other systemic risks are hiding in the complex algorithms that we blindly trust every single day? Thanks for joining me for this explainer. Keep asking those hard questions and always look closely at the data.